Welcome to the first episode of Recap. My name is Brandon Roth. The goal of this podcast is to share with you different capital providers in the commercial real estate finance world and to get a better sense of the different buckets of capital they have available, how they're viewing deals, what their outlook is on 2024. So our first guest is Shawn Cully. He's with Prime Finance. He's a very well-known bridge lender, having closed over 200 loans and $5 billion in deal volume. And we'll jump right into it, getting started, asking Shawn, how did you get started in commercial real estate finance?
So it was pure accident. I would say that. So it was a college kid who was a sophomore in college, had no idea what he wanted to do with his life, except that he didn't want to go back to Western Pennsylvania, where I'm from, and work the jobs that I had the previous 2 summers, which was digging ditches and carrying heavy things in a factory. So end of my sophomore year, I thought this is a good time to start looking into internships, or else I'm going to be back with a shovel in my hands, and I don't really want to do that. So I started to reach out to some alums, all different industries, not real estate exclusive. I was an economics major, so it was finance oriented in some way, but even sales jobs. But I happened to connect with an alum who was the head of a CMBS group in Los Angeles and just happened to be looking for a summer intern. And so it was fantastic, right? I had no idea what CMBS was. Kind of didn't even know what commercial real estate was, but it's funny. To this day, I still have a little cheat sheet on a piece of paper that he gave me my first day that here's what a debt service coverage ratio is, here's what a debt yield is, here is what an LTV is, all these acronyms. And it took me like 3 weeks to master all of those. So that was the start, but it turned into a career. And here I am 20 years later.
And so was that 2004 then? That's when you first did your internship, right? Right.
That was 2004. So I ended up 2 internships at that spot, ended up doing 2 years in CMBS.
Right.
2008, the credit crisis, we all know what happened there. Ended up moving to a mezzanine shop. Mezzanine lender, was there basically for the workout party in San Francisco, 2008 to 2010. 2010 moved over to Prime Finance and have helped grow that platform as the lead originator on the West Coast into what is now our 8th fund in 15 plus years of business.
Sure. I've always thought of Prime as one of the groups that's been in the debt fund space much longer than most other groups in the market. Prime's very well known by everybody. So in terms of how Prime got started, that's dating back, you said 15 years with Scott Douglas getting...
That was 2008. So it was Scott Douglas, Steve Gerstung, and John Brayshaw, who were the head of the CMBS group at Natixis.
Right.
The backstory is basically they had a relationship with Prime Residential, who's a large owner-operator of apartments on the West Coast. They've been around since the late 1980s, own some just phenomenal assets on the West Coast, and they had a lending relationship with Prime Residential. They had financed some of their properties. 2008, the GFC had moved from residential to commercial real estate, and these Natixis guys had this idea that it was a good time to start a private real estate lending company because every other traditional lending institution in America was going to have major balance sheet issues. And there was just going to be a void in capital markets for commercial real estate finance. That turned out to be certainly, I say, prescient on their part. Right? They were completely right with that. So they partnered with Prime Residential, who had access to capital, to form our first fund in 2008 and start lending on commercial real estate. And I can tell you that was good times. There was not much competition back then.
Right.
And since then, we are now progressed through our 8th fund. And not to pat ourselves on the back, but everyone knows like debt funds are more of a household, I would say, a more household vehicle in commercial real estate capital markets now. And I think we certainly had something to do with this. We weren't the only ones in 2008 who were lending in this fashion on commercial real estate, but we are certainly one of the most long tenured in the space, I'd say by far. I always joke it's like dog years in debt funds, right? If you've been around for 15 years, it feels like actually like 100. So we're kind of one of those original groups who figured out how to make it work, and now there's a bunch of groups, and I'd say it is a backbone of commercial real estate capital markets now. The debt fund, quote unquote, vehicle.
Right. No, absolutely. what would you attribute the longevity to in terms of how Prime has been able to just withstand multiple different market cycles in different environments where we've seen many debt funds kind of come and go as there's different shocks to the economy, but it feels like Prime has always been steady and has always been available to their clients. Is there anything specific you might attribute that to that you guys might be doing different than anyone else?
Yeah, a couple things. So the first thing I would say is just luck. When we started in 2008, it was pretty easy, right? There was a lot of opportunities, and the pricing was super advantageous. Investors obviously like that, so we're quickly able to have a couple of very successful funds that made investors happy, solidified us as one of the go-to guys in the space, and from there we're able to build on that initial success. Secondly, I would say that the partners had a vision, and they're very smart guys. They've steered the platform in a very good direction. They have treated their employees exceptionally well. So I've been there for 13, 14 years now, and that simply wouldn't be the case if it wasn't a strong, growing platform where I was compensated well, et cetera. So
Right.
I'd say a thing that really sets us apart is that if you look at our lead personnel below the partners, the 5 originators in the firm, for example, our head of asset management, our head of capital markets, everyone has been there since at least 2010.
Wow.
Which is kind of unprecedented in the space. Like that is not typical, right?
Mm-hmm.
So the fact that we've had that cohesion between all the different, I'd say, levers within the platform means that generally, not only are we getting along, obviously, but we're collectively making decisions. My credit committee, they trust me. I know what they expect of me, so I can deliver that. Same thing with our asset management, same thing with our capital markets. So I'd say there's 4 pillars of any strong debt fund: the capital markets, the asset management, the originations, and then ultimately the people who are approving the deals. If all of those guys are in lockstep, then you're going to have a successful, enduring platform. If any one of those 4 things are eroding or not there, then you're going to have bumps in the road eventually, and it might end up capitulating your entire platform. So
yeah, that makes perfect sense.
I'd say, yeah. So we got in at the right time, first and foremost. Which credit to the founders. They took a risk there. They saw an opportunity, and it paid off for them. And then secondly, I think we've been blessed to have a very smart group of people steering the ship for the last 15 years, and it's resulted in a successful, cohesive group.
Right. Yeah. And in terms of maintaining a consistent reputation in the market, I think the longevity of the employees at Prime help with that because you know exactly what your investment committee is going to approve. So when you're talking to borrowers and you say, hey, we can do X, Y, and Z, or we can't do this other type of asset type, for sure because you've already been working with the same guys now for 14 years and you know what can get done and what can't, versus the opposite being true for a loan originator who may be new to a debt fund, doesn't truly understand the investment committee parameters and giving information to borrowers that they rely on that can't be delivered. So to the point being, you've had such a solid group of guys for such a long time that I think it's just kind of compounded your reputation in the market because of the consistency.
That's exactly right. So I'd say the strongest aspects of our business are the reliability. Right? We pride ourselves in executing on what we say we're going to do, from a quote to a term sheet, even when times are tough. I would say even at the onset of COVID, right? We were, I think, probably the only one of my peers, or there weren't many. We weren't the only one, but we were one of the few who stood by term sheets. We didn't leave borrowers with deposits on acquisitions that they had to forfeit at the 11th hour. We closed on some really, really tough deals that I can tell you at the time I really did not want to, but that sort of reliability obviously pays dividends in the future, and it's what we built our platform on. And then secondly, I'd say our asset management. We've invested a lot in our asset management. In the space we're in, you need to. If you're relying on a third party, you're outsourcing it, you're going to have issues, right? You're just not going to provide the service to your borrowers that you should and what they need and what they expect. And we're in value add real estate space with business plans that take twists and turns every single loan, right? Like every single loan without fail 90% of them at least, there is going to be something that needs to be modified or switched along the road during a 5-year business plan. And if you don't have that in-house expertise and that communication, you're not going to provide a good service to your borrowers. Right. So those two things.
Yeah, no, that makes perfect sense. So I do have some questions specifically about prime and the different buckets of capital, but I think before jumping into that, there's going to be people listening that aren't familiar or as familiar with the commercial real estate finance world as others. And so maybe just to create a baseline, can you just describe quickly what a debt fund is and how it works compared to other types of financing that people might be familiar with, in the bank world, for example? What's unique to the debt fund space and how are they created?
Yeah, so they're created, I'd say the simplest way to think of it is it's a private finance company for commercial real estate, right? So you think of traditional lending sources for commercial real estate, you think of banks, which are lending from deposit bases, and insurance companies, which are taking in premiums off of policies and then investing those out. The debt fund is something that pulls private capital either in a fund, like you would think of a commingled fund for ownership of real estate, or through a publicly traded REIT, and then uses the proceeds from either the fund or the capital raised from the REIT to go lend on commercial real estate. So that's the simplest way to think of a debt fund, is that we're private capital dedicated to commercial real estate lending.
Got it. In terms of how warehouse lines, A notes, repo lines, CLO market, can you describe how that impacts the debt fund market, right? Because the reality is you're not looking for SOFR plus 3% pricing, right? You're looking to now lever that behind the scenes with a different source of back leverage from one of these different providers to generate higher returns in the 11 to 14% range. Can you just maybe talk about the different types of back leverage that are available to debt funds?
Sure. So that's right. We're lending at SOFR plus 3% currently. Most debt funds, I can't say what we target, but most debt funds think of generally an 8 to 14% net, somewhere return to, depending on how high or low they are up the risk spectrum of lending. So the way you achieve that from, say, lending at, SOFR was historically low, how you got from a 5% all-in rate on one of my loans to call it a 10% net, was that you use balance sheet leverage. And there's a few different ways to go about that. I would say the most efficient way, and one of the things that, again, because of our long tenure and the skill of our capital markets team, and kind of being a first mover in the space, we've built up these relationships, is to have a series of warehouse lines. So the way we typically would finance our balance sheet is saying I'm making you a $100 million loan. I'm going to fund that all cash out of my fund. Behind the scenes, once the loan is closed, I'm going to pledge it as an asset on one of our warehouse lines with a money center bank, right? Mm-hmm. And so say I make you a $100 million loan, I might borrow or pledge 65 against the warehouse line. They charge me SOFR plus 250. I charge you SOFR plus 350. And then I keep the difference, and that ends up being that net return.
Right.
That's the most efficient way. The most cost-effective way is a CLO. It is typically the cheapest execution because you're diversifying risk across many different pools of bond buyers. Mm-hmm. So it just tends up the weighted average spread when you do that execution, issuing the bonds. It tends to be tighter than what the warehouse lines are going to provide you. Also, most significantly, why people like it the most is that it's completely non-mark to market. And when I say mark to market, I want to be clear: the warehouse lines aren't spread marked. Like traditionally you would think pre-GFC, it tanked a lot of funds, is that when spreads blew out, in theory, the loans that you held were way less valuable. Think of it like a bond, right? When treasury yields blow out, then your bonds that you hold are less valuable, right? Because mm-hmm. the spread, the interest rate on those bonds are. So, anyways, that used to have spread marks, right? Where you'd have volatility in the market, spreads would blow out. All of a sudden, your pool of loans, your assets on your balance sheet would theoretically be much less valuable. And then you get a call from a money center bank saying, "Hey, you owe us $100 million tomorrow because spreads just blew out," right? So mm-hmm. that is not mark to market on warehouse lines. When we say mark to market now, specifically on our lines, we're talking about certain debt yield metrics on pools of loans that are tied to performance of the underlying real estate, right? So it's not this synthetic ability for banks to margin call you. It's directly tied to performance of the loans. So to make that clear, how it works for most of the, I would say the upper echelon debt funds now. That's how the lines work, certainly for us. But so the point is, on the warehouse lines, you're still subject to some sort of margin call risk if your loans are underperforming, right? That risk is inherent. In CLOs, it's different. You do not have that risk, right? It's just static. You can never be margin called. So that is obviously super attractive in a volatile environment where commercial real estate values and performance might be choppy in a moment in time. The problem with CLOs is that you're taking market execution risk, right? You generally, if you have the ability, not everyone does because they're hard to get it. If you have the ability to get lines or multiple lines, which really is what you need to operate a debt fund into perpetuity and efficiently, you generally know within a certain bandwidth what your cost of capital is going to be and that you have a place for your loans. If you're relying solely on the CLO market, you don't really know. Think of it like security. It's not securitization because you're retaining the equity piece, generally the bottom 15, 20% of the portfolio of loans. But you're taking securitization like risk where you're subject to capital market pricing at any given moment in time and that sort of volatility and whether you can even get a CLO off. So there's a potential to have a portfolio of warehouse loans and then the CLO market is completely closed and you can't even lever the loans, right? And then if you're trying to return your whatever it is 8 to 14 to your investors and you have a bunch of loans that pay 5%, then your fund is in big trouble. So that's the problem with CLOs. The other problem with CLOs is workouts, right? When individual loans do go bad in a CLO, it's much more burdensome to really modify them as compared to if they're on a warehouse line or an A note.
Got it. Yeah, and that makes me think about certainty of execution, right? Because in my role as a broker, as you get a debt quote matrix, right, with a variety of different debt funds, it's important to know what is the intention of each debt fund in terms of how they're going to lever this behind the scenes. Because for those debt funds where their only execution may be in the CLO market, it's potentially more risk for the borrower versus somebody like Prime that has multiple options, right? Even though your primary intention may be to do it on CLO, you still have all your warehouse lines as backup options if the CLO market were to blow out. That way you could still close on the terms that you originally agreed to, a month prior in the original term sheet.
Yeah, that's exactly right. And I'd say I've been taking a step farther. It means that you can lend in all cycles. Right. So historically, our best loans that we've ever made have been times in high volatility in the commercial real estate market. I mean, shortly after COVID, nobody was there, partly because the CLO market was completely closed. Certain other times in our history when there's been that volatility in the CLO market is completely kaput. It's shut off. We've made some of our best loans. So it's the ability to be there. If you're only lending at the top of the market, right, when capital markets are humming, you're going to make some bad loans, right? you just will, right? If you are able to lend during downturns, if you have the balance sheet financing, then your brand is going to have a better reputation, right? Because you're always there. You're not taking any breaks. You're never in and out of the market, which you see with a lot of debt funds. They're in, they're out, they're here, they're there. If you're consistently lending, then it's obviously good for your brand. And then to your point, certainty, right? If you're willing to take more, which we are, if you're willing to take financing risk on your balance sheet, then you're going to have better product in terms of what you're meeting your borrower's expectations. Right. And so our theory has always been, if we're making really good loans, right, that we believe in and have conviction in, then we're going to find financing for our balance sheet, on our balance sheet. And historically, that is proven true. And I think it's been a big boost for our platform and our brand.
Sure. And I think that might be a good segue into talking about, for Prime today, given what's going on in the market, is there a certain segment of the market that you're most focused on? Are there certain deal types that you're chasing more aggressively than others, for example, or maybe certain asset types that you're avoiding altogether?
Yeah. So, obviously there's some that are tougher right now. Office is tougher. Right. That being said, I think we're one of the few groups out there financing office right now. So I think we did 5 office loans last year. And really, the only way we're able to do that is because we have the balance sheet financing to be able to do that, right? We have a relationship with the line lenders and a multitude of line lenders where we can place these loans on lines and make the levered return that we want.
And I'm sorry, Shawn, can we pause right there for a second? Because that's unique, right? And you don't hear a lot of people financing office today. Is there a certain profile of tenancy in these office buildings that somebody needs to hit to be attractive, for prime?
The bar is incredibly high. Yeah. So if you're calling me with a vacant, don't call me with a vacant building. Don't call me with a Class B building. Don't call suburban 1980s building. That's not happening. So when I say office right now, they usually check a few boxes, or they are checking a few boxes. It's got to be Class A quality. It has to be an elite sponsor. It has to have good cash flow in place, and it has to have some WALT on the leases.
Sure.
If you bring me a single tenant office deal and the tenant rolls in 2 years, it's probably not going to be for us. Sure. But if you're able to check all those boxes that I just mentioned, then yes, we're going to be selective, but we think that obviously the flight to quality in office is real. There are still very good credit office deals in terms of tenants who are investment grade credit or close to and are fully utilizing the office space. Right. And historically you're at a basis that would be unthinkable back even 2 years ago on these assets. And then obviously the economics are super attractive as well.
Yeah, no, that makes sense. And I would imagine that from your senior leverage, the advance rate is going to be lower, the pricing is going to be higher from that group. So it's going to impact the terms that you can provide to a new borrower. So is there maybe a high level range of how you guys are looking at office deals that check all the boxes? Is it like a SOFR plus 5 to 6% type of capital where multifamily might be in the 3s? Or what does it look like from a spread perspective typically?
Yeah, so I just say I'll start with leverage. I would assume if you're bringing me an office building, it's probably going to be 60% LTC max. It's going to price somewhere between SOFR, maybe the best case scenario is SOFR 450, up to SOFR maybe mid 5s. But most deals are SOFR plus minus 5, like you said. Compared to a multifamily where we might do that, we're going to do that at 70, maybe 75% LTC at SOFR plus very low 3s. Right. Most likely. So it's much more expensive in conservative capital, but we are filling a clear need in commercial real estate capital markets right now. There's no doubt about it.
And maybe what about from a check size perspective in terms of minimum loan amount versus maximum loan amount where you'd entertain a deal like that?
Office specifically, or just?
Yeah. Well, maybe if it's different for office and other asset types, that'd be interesting. But in general.
Yeah, so I would say our biggest check size on a multifamily deal, or say an industrial deal, or something like that, is probably going to be $300 million. We haven't done a $300 million deal in a while, but we did a $220 million office deal last year. I'm sorry, multifamily deal. We did not do a $220 million. But we did the year before in San Francisco or the San Francisco Bay Area for an elite sponsor, really good credit, fantastic WALT. We did a $160 million office loan. So we're willing. It's going to be clear, it's going to be very selective, but it's not a no. And again, I think we have the ability to do that again for the reasons I mentioned before.
Sure. And I'm sorry, I stopped you when you're describing the different asset types that you guys are either being more cautious on, like office, versus the asset types where you guys are being more aggressive on. Can you continue along that thought process?
Sure. I'll start with the negative, I guess. I started with office. So I'll start with that. Obviously, life science is having a turbulent period. So that's something we've always been really conservative on because, frankly, we were just never experts on it. And we're not going to lend on things that we don't fully understand. And I would say that was always not to say we didn't do any of it, but certainly not to the extent, I think, of probably some of my peer set. But it's something that we're certainly more selective on now. We're also, I would say, cautious on multifamily in certain markets that are just laden with supply. I mean, there is markets now that have performed super well this past, I'd say, post-COVID cycle, but we think the numbers are pretty obvious that there's going to be bumps in the road just given the massive amount of supply that's coming into certain markets, right? Mm-hmm. Not to say that we wouldn't lend there. We might not be as aggressive as some other groups. Conversely, there are other markets that have been beaten down severely that we think there might be opportunities now. Some West Coast markets that have taken it on the chin, and we think prices have bottomed out, and it might be an opportunity to step into those markets where 3 years ago we would have no opportunity to lend in those markets because they were, core markets.
Right.
It might be time to find some opportunities there. But multifamily in general, like everyone else, it is the safest asset class. It will continue to be. It's 60% of our portfolio, maybe 65%. And then hotels, industrial, office are going to fill in the gap.
In terms of potential case studies, is there anything that maybe you've quoted recently that you're able to talk about if we're not talking about the borrower or the deal type, just to give people a flavor of, where is prime, active right now? Or maybe it's a recent closing, for example.
Yeah, recent closing. So let me think about something that's actually interesting. So we've done a whole bunch of C of O multifamily. Multifamily that's gotten C of O is in lease up, not ready for obviously a permanent execution. Mm-hmm. And we've stepped in, taken out the construction loan, maybe taking out the pref equity as well, depending on the market, the leverage, and the last dollar point, our basis. So that has been the most active space that we've been in for the last year. Some unique deals, I would say, is obviously the office. Some hotels. We've been aggressive on hotels, like a lot of people have. Maybe a unique deal. Oh, here, one that we're closing right now. Historically, we've always had the theory, maybe sets us apart from some of our peer set as well. And frankly, I'm thankful now because we weren't solely relegated to gateway markets, which had some trouble coming out of COVID. But we've always had the thesis that if you lend on the best asset in a secondary or even tertiary market to the best sponsor in that market, then it's going to perform better than maybe the 100th best asset to the 100th best sponsor in a core market, right? So we've always been agnostic is probably an overstatement, market agnostic, but we've been willing to go into markets that some of my peers just aren't. Secondary locations and tertiary locations that maybe you've never heard of. So actually, we're doing one of those right now. I'd say most people probably have never heard of this place. It's in Eastern Washington. Nice, like a good local regional place, but not a place that is on the tip of tongue of any lender who's out trying to make loans right now. But we think we found a developer who's best in class, not a household name, but best in class. He's going to build by far the best asset in this smaller market. And we think that's historically, that's been a really good bet for us. If your asset, I would say, has monopolistic characteristics, even in a secondary or tertiary market. So that's unique about it. It's also going to be done half C of O, half to be obtained C of O. So we're going in, there's two buildings. One of them is going to have C of O at the time of closing and be in lease up. The other one is going to be 2 to 3 months away from C of O. So a lot of groups aren't willing to do that. The pre-C of O execution, especially in a market that is not a household name, but it's a unique deal that we're closing right now and working through, and one that we're pretty excited about.
Yeah, no, that sounds super interesting. And going back to the other deals that are at C of O, where it's just one building, not two, like the one you just described, because there's going to be thousands of those across the country. How do you size that? Are you looking at stabilized NOI and a stabilized debt yield, or what are some of the primary metrics that you're focused on when you're figuring out your loan amount on those deals when you don't have any historical cash flows?
Yeah, primarily stabilized debt yield. Primarily stabilized debt yield. Where do we think our cash flow is going to be in 18, 24 months when it's through the lease up? And then what is our takeout risk based on that cash flow?
Sure.
That's the primary metric.
And it makes sense that it would vary based on the region because you're going to have certain lower cap rates in some areas, higher cap rates in others. But broadly speaking, would you say that something like 8 to 9% stabilized debt yield? Is that the bandwidth?
Yeah, I would say it ranges right now from 7.5 to 9.
7.5 to 9.
Depending on the market. Yeah.
Got it. Okay.
Depending on the market.
Got it. And then across the country, there's a lot of borrowers right now who originated loans back in 2021, and they're going to have loan maturities this year, right? And if you look at cap rates 3 years ago versus now, the properties may be, severely over levered. And so there's a lot of loan modifications happening with all lenders. And I realize that's a sensitive topic and every deal is bespoke. But if you were to give any guidance to how borrowers should either approach their lender or what the expectations should be, what could you share in terms of, what's the right way for a borrower to go to their lender, given the situation where they might be 95 to 100% loan to value?
I would say they run the gamut. And obviously, like every lender in America, we are doing this right now, right? You cannot have a run up of 500 basis points in floating rates in a very short amount of time and not have things break. It just does happen. So I would say, the modifications or workouts, they run the gamut from, hey, we just need some more time to see the light at the end of the tunnel and not have this maturity facing us, staring us in the face. Like, can you just give us some more time? Right. That's the easiest resolution. That's pretty easy. If you're going to continue to pay debt service and execute your business plan, and we think you're a good sponsor, and the property metrics are migrating in the right direction, then that's a pretty easy resolution. If you are severely impaired, meaning your equity, then you have a choice, right? If you are willing to come to the table with more capital, meaning continue to pay debt service, number one, and that might be seeding a carrier reserve if you're not covering debt service. If you're willing to pay down the loan, then generally you're going to have a favorable outcome, right? You're going to get more time. If you're willing to continue to invest in the asset, pay your lender, you are going to get, most likely, you're going to get more duration, right? That seems to be an accommodation that most lenders are willing to make. If you are completely upside down and maybe even the loan's impaired, then it's obviously a little more tricky, right? So if you are coming to the lender and you're asking for everything, you want to accrue the interest, and you want maybe even principal forgiveness, and you want increased funding for whatever your business plan is, renovation, tenant improvements, leasing conditions, right? You want to add on to the debt burden. That's going to be a really tough conversation, right? That might just be, there's no deal to be done. So I would say to borrowers, if you believe in your assets and you have the liquidity to stand by your assets, continue to pay your lender, invest in the property, maybe even pay down the loan, then I would say high probability you're going to have a favorable outcome in terms of having time to hopefully see a rosier capital markets ecosystem down the road. If you're not willing to do those things, then it's going to be tougher, right? And there might not be a resolution.
Yeah, no, that makes sense. How much does the source of your back leverage impact the modification? For example, if it's a warehouse line versus CLO, is there any difference in your options from a modification perspective?
Yeah, so the CLO is the trickiest, right? Because you are, like CMBS, you're dealing with a special servicer. Now, it's certainly a more nimble and a responsive product than CMBS. I want to make that very, very clear. You have a lot more latitude to modify loans in a CLO than I would say CMBS, right? It's just more efficient. At the same time, it's certainly not as efficient as if you just have a loan on a line. Like it's just not. And if a loan is really soured, especially I should say that if it's a small modification, right? If it's a small modification, those tend to be achievable, at least half the time, right? At the same time, like we, as lenders, we're responsible to our bond buyers, right? Like they are our clients, right? Especially groups that have been prolific CLO issuers, right? We view our bond buyers as partners, and we need to stand by our loans in times of turbulence. So the expectation from the bond community is that if a loan is severely impaired, that the issuer is going to buy the loan out of CLO, which is obviously super expensive, right? So say I made you, back to my example, I made you that $100 million loan. I put it in a CLO. Leverage in CLOs tends to be, or advance rates, I would say, on the loans tend to be higher than on a line. A line might be 70%, a CLO might be 85, 87%. Say that loan goes sour, $100 million. The expectation from the bond buyers is that I go purchase that $87 million piece out of CLO. Right. Now, obviously, that takes serious liquidity on the part of the issuer. And not every group can do that. Right. It's just not something, or even the most well-capitalized groups, if you have multiple sour deals in a given pool or across or different pools, then you're not going to have the liquidity to do all of them. So that is the real, I'd say that's a trap in modifying loans that are put into CLO. You do have way less flexibility than if it's placed on a line. Those conversations are much easier. But at the same time, there's still conversations. Whatever leverage you do have, it's not the bank of Shawn Cully making the decision. There's other parties involved.
Yeah, no, that makes sense. And I think there were a lot of bridge loans that were done in 2021 with debt funds that use the CLO market for their leverage. And those are going to come due this year. So it's going to be interesting just to see how that plays out, given how many of those were done across the Sun Belt at low cap rates that are going to be underwater today.
I'd say interesting is the right word.
We'll follow up. We'll do a follow-up call on that one. Yeah. And maybe just to wrap up here, just wanted to get your thoughts on 2024. What are your expectations on what may be different this year versus what you guys saw last year? Is there anything that you see on the horizon that might be different, maybe based on the loans you're already seeing in January, for example, in terms of new loan requests, or what do you see as changes in 2024?
Yeah, so I think like everyone, we're hopeful there's more deal velocity, right? More deal activity. 2023 was the acquisition market was moribund for a whole bunch of reasons, right? Interest rate instability, problems valuing assets. There was just no transactions last year except for refinances, the handful of I'd say off-market acquisition deals, and C of O, things coming off of construction, like a multifamily deal. So certainly the hope, and I think the expectation is that there's going to be more acquisition volume this year. It seems like we have some interest rate stability now. At least we're at the end of hiking. So you can determine your cost of capital with a lot more certainty, obviously, is what you need first and foremost. There's more liquidity from lenders in the marketplace. CMBS is active again. CLOs are active again, so more bridge lenders are active. Banks seem to be more active. So there's more liquidity from lenders. So those two things, right? Understanding your cost of capital and just capital from lenders, those are going to help with acquisitions. I think a lot of business plans that were done in 2020, 2021 are going to be some forced sellers, right? Where you just have to divest for some reason. For a multitude of reasons, right? You can't carry the property anymore. Your lender makes you, or LP fatigue, which we're starting to see. Guys who maybe bought the property in Las Vegas in late 2020, early 2021. Right now, maybe your equity is impaired to 40 cents on the dollar, right? And you have the option. You can keep carrying this property and maybe get back your full dollar 5 years from now. Or you can just say, hey, life's too short. I'd rather have 40 cents on the dollar today. Just give me that back right now, today, GP. I'll take the 40 cents on the dollar. I'll go reinvest it in something I'm actually excited about. And let's just move on and fight other battles. Right. I think you're going to start to see that sort of fatigue, specifically in the second half of the year. And we're already seeing it on certain assets. So right. I think those three things combined, provided that the economy stays in a healthy condition, which by all indications it seems that way. I think there's going to be more deal activity. So we're obviously looking forward to that.
As we all are. Yeah, I think 2023 was slow for a lot of people, and 2024, with all the increased loan maturities based on 2021 originations, I think people are excited about the potential of increased transaction activity.
Yeah, for sure. Yeah. Now, that being said, right, there's still a lot of issues to work out on people's existing balance sheets like that. For that acquisition activity to take place, there also has to be losers.
Right.
It's just that simple.
Sure.
It is a zero sum game.
Right.
So everyone, the question right now, you're coming out of the conferences, right? IMN, NMHC, everybody wants to be a net buyer this year. Everyone has capital. Everyone wants to be a net buyer. You ask those same people, well, are you a seller this year at a 575 cap on your multifamily? And they're, oh, no. There's absolutely
Sure.
not. So will supply meet the demand? Probably not. But will supply increase over 2023? I think that's a pretty safe bet.
Right. Yeah. I think that makes sense. All right, Shawn, I appreciate you doing this. I think this was a lot of great information. I think it's going to be really helpful for people from, who aren't even in the commercial real estate finance world versus those who are doing it every day and learning about what's going on from your perspective in the market. So I really appreciate you taking the time out of your day to do it.
Yeah, absolutely. It was a lot of fun, and I appreciate the opportunity.